As it turns out, not everyone is generating free cash flow in this gold environment. Some have instead elected to prioritize growth efforts over stacking money in a bank vault. And well, the market doesn't seem to like that idea. Just ask Eldorado Gold about it, who sunk as much as 3.4% on Friday after posting Q1 results that, well, had no free cash flow. Instead, they prioritized that cash on growth projects, primarily their Skouries mine in Greece. Let's dive in. Eldorado Gold in the first quarter recorded $355 million in top-line revenue, an improvement of nearly 38% on a year-over-year basis versus the $258 million in revenue recorded in the first quarter of 2024. This improvement follows the company seeing their gold sales during the quarter being flat at around 116,000 ounces. The improvement was entirely related to the rise in gold, with the average realized price increasing 41% on a year-over-year basis, going from $20.86 to $29.33 an ounce. Net earnings for the quarter improved from $33.6 million or 16 cents per share to $72.4 million or 35 cents per share, an improvement of 115%. On an adjusted basis, earnings improved from $55.2 million or 27 cents per share to $56.4 million or 28 cents per share. The lack of change here is the function of $63.4 million in unrealized losses on derivative instruments and a $73.5 million recovery from a deferred tax asset that skewed net earnings results. Adjusted EBITDA, meanwhile, improved from $119 million to $163 million on a year-over-year basis. Cash flow from operating activities before changes in working capital improved from $108.3 million to $136.5 million. However, free cash flow came in negative. Free cash flow amounted to negative $21.8 million as a result of expenditures at Skouries versus negative $30.9 million in the year-ago period, which was also a result of development at Skouries. Excluding the Skouries project, free cash flow is said to have improved from $33.7 million to $75.5 million. Despite the lack of free cash flow here, Eldorado is doing well in terms of their balance sheet. Cash and cash equivalents improved from $515 million to $978 million on a year-over-year basis, thanks in part to Eldorado's sale of their interest in G Mining Ventures, while debt increased from $644 million to $933 million. Total assets also increased, going from $5.1 billion to $6 billion over the same time frame. Let's move on to the production data here. Eldorado Gold in the first quarter produced 116,000 ounces of gold, which was down marginally from 117,000 ounces in the first quarter of last year. Production is said to have been in line with expectations at the FM Kukuru, Kisladog, and Lamaque operations. However, Olympias came up short, with the mine experiencing unplanned maintenance that is said to be related to pyrite concentrate filtration and issues with the flotation circuit. Broken out, Kisladog saw production increase 18% year-over-year to 44,000 ounces. Lamaque saw production decline 4% to 40,000 ounces, and FM Kukuru saw production improve 4% to 19,000 ounces. Olympias, meanwhile, saw production drop by 37% as a result of the unplanned maintenance, falling to 11,829 ounces. Cash costs were up a substantial 25% year-over-year, rising from $922 an ounce to $1,153 an ounce, while all-in sustaining costs rose 24%, going from $1,262 to $1,559 an ounce. The increase here was said to be primarily a result of higher royalty expenses due to the higher gold price, alongside what Eldorado referred to as impacts from labor. Royalty expenses specifically increased from $14.2 to $22.2 million on a year-over-year basis, contributing roughly $190 to cash costs on a per-ounce basis, versus $122 an ounce in the year-ago period. Despite the issues at Olympias, Eldorado has reaffirmed current guidance, which calls for production of between 460,000 to 500,000 ounces of gold this year, with production weighted to the second half. Those ounces are expected to be produced at a cash cost between $980 and $1,080 per ounce sold, and at all-in sustaining costs between $1,370 and $1,470 an ounce. Time will tell whether those figures are actually achievable, however. Lastly, there's Skouries, which Eldorado continues to throw cash at as they work towards achieving production. As of March 31st, the Skouries project is said to be 66% complete Phase 2 construction. The project continues to be plagued by labor market tightness, with Eldorado back in February blaming this market tightness on capital cost increases of $143 million, bringing total costing to $1.06 billion for the mine. Accelerated operational capital of $154 million is also expected to be spent upfront, which is part of an effort towards pre-commercial production mining and the acceleration of the purchase of higher capacity mining equipment. The project, meanwhile, is said to still be fully funded, with the production of a copper-gold concentrate expected in the first quarter of 2026. Gold production next year is slated to be between 135 and 155,000 ounces, alongside copper production of between 45 and 60 million pounds, with commercial production slated to be achieved mid-next year. Capital expenditures on the project totaled $83.8 million in the first quarter, alongside accelerated operational capital of $6.4 million. To date, $589 million in project capital has been spent on the Phase 2 construction, in addition to $13.4 million in accelerated operational capital. Total capital spend this year at Skouries is forecasted to be between $400 and $450 million, while that accelerated operational spend is expected to be between $80 and $100 million. All right, so let's wrap it up. Eldorado Gold continues to have a free cash flow problem, which is generally fine provided that the funding is being put towards growth and there's a timeline to completion. In this case, that's next year, so I suspect that free cash flow will continue to be non-existent for the remainder of 2025, barring something outrageous like gold continuing to move higher yet from here. Outside of that, the company has been consistent with their results, so it's a bit difficult to really complain here. Olympias had some problems, but that shortfall was basically made up somewhere else in the portfolio, which just reinforces the idea of why you don't necessarily want to be a single asset producer. In any case, it will get resolved and those ounces will just come out of the ground later. All right, everybody, thanks for watching. If there's stories you want us to cover, please let us know in the comments section. Also, I appreciate every one of you that takes the time to comment, watch our videos, give us a like. So thanks so much for watching this content. And we're going to have a lot more coverage here during earnings season. So if you're looking for that stuff, check out the rest of the videos on our channel. All right, everybody, thanks for watching.